But moving on, a very important management, Tata Steel reported a good set of fourth quarter numbers. EBITDA per ton is higher than expected, while loss in the European business is the lowest in 6 quarters. Our colleague Nigel spoke to TV Narendran, the CEO and managing director of the company, and began by asking him about the European business. Let's listen in to that conversation.
A couple of things have happened in Europe. Last year, we had a bad year in Netherlands because one of the 2 blast furnaces was down for relining, which took longer than we thought. That blast furnace is back in operation since February, and we are pretty much back to normal production. So you saw some impact of that in the Netherlands numbers, but starting this quarter, we expect Netherlands to be positive EBITDA. So that's not a one-off, that's a trend which will continue. You'll have a positive EBITDA starting this quarter and for all subsequent quarters in this year. In terms of UK, we had a one-off, which was roughly about £50 million, which was more an adjustment on the carbon credits that we have and the set-offs that we need to do and the hedges that we have, etc. So that 50 million will not be there for this quarter, which was there for Q4. And but going forward, in UK, we expect Q1 and Q2 to continue to be tough because of the fact that we are winding down our operations. We have the coke ovens already closed in March. We'll close 1 blast furnace in June, and we'll close the 2nd blast furnace in September. But we expect the second half of the year to be positive EBITDA in UK as well.
Okay, all right. So you're saying that the European business on the whole then will turn EBITDA positive from the second half of the year? Or is there a possibility in Q2, since Netherlands will already turn around, that we could see a positive EBITDA number?
So Netherlands will clearly be positive starting Q1. Okay. In UK, since we are going through this transition, we have a lot of closure costs. We have an unstable operation because you're closing it one by one. While I have a set of numbers, I just want to make sure that I don't guide wrongly. So Netherlands will be positive. UK will be positive in the second half.
Okay, got it. Well, Mr. Narendran, coking coal costs, that seems to be the joke on the pack, right? Because in the past quarter, it would hurt your operations. While at current prices, it could help in the coming quarter. That's Q1. So could you tell us what was the hit? What was the increase that we saw in coking coal costs for the past quarter? And what kind of a relief will you expect in the coming quarter, both for the India as well as for the European business?
So both for India and Europe, the coking coal costs went up in Q4 compared to Q3, maybe less than what we had guided. So in India, if I remember right, we had guided a $10 increase in coking coal consumption. We ended up at some $5 increase, and similarly in Netherlands and UK. Going forward, coking coal is not an issue for UK because we've already closed the coke ovens. Netherlands, we expect the coking coal consumption cost to go up by about 20 euros this quarter compared to the last quarter, largely because of the inventory that is there. But the purchasing is currently going on at around 20-25 euros per ton lower than the previous quarter. In India, the coking coal is being bought at about $35 per ton lower than what we bought last quarter. Consumption will see a benefit of maybe about $10 per ton this quarter, and the balance will flow through in the subsequent quarters.
So safe to say that the India EBITDA per ton improves because you'll have the benefit of lower coking coal costs, and also give us some color about how much higher are prices today in India in comparison to the past quarter.
So we expect prices in India as we stand today to be about 300 to 400 rupees higher in Q1 compared to Q4, because while prices have gone up in the last few weeks, it had gone down till March. So, there's a climb back which is happening. In terms of margins for this quarter, I wouldn't say that it will get better simply for the reason that this is a quarter for shutdowns in India. So we have a lot of shutdowns, so the volumes are going to be a bit lower. So while the spreads will look a bit better, the volumes will be a bit lower, and hence a little bit of fixed cost distribution over a lower volume will happen. So you will see some drop in EBITDA in Q1 compared to Q4, but on a full year basis, you will see, you'll start seeing at least flat, and if the prices improve, then we'll see an improvement.
Okay, got that. It makes perfect sense. What about the debt number? You've done quite well actually in maintaining the debt number on a sequential basis in spite of having a 4,500 crores of Capex. So what is the Capex plan you've lined up for this year? That's for FY25. And what happens to the debt? There's no scope to reduce debt from here because you'll be having the UK business alignment that you've been talking about, as well as the India Capex as well will weigh. Your take?
So this year, our guidance is that the Capex will be around 17,000 crores. More than about 75% of that will be spent largely in India. The net debt levels, we are expecting to be in the 77,000 to 80,000 crore range. We don't expect a significant reduction in net debt. We want to keep it as flat as possible. But the net debt to EBITDA will come down from the current levels of 3.3 to less than 2.5. Maybe we'll be at 2.3, 2.4 by the end of the year. So that's largely what we are guiding.
Okay, and about this Capex plan, how do you see commissioning of the additional volumes coming on stream?
So the physical completion of the blast furnace in Kalinganagar will happen in June. Already the stove heating has started. The chimney heating of the coke ovens has started. We expect the blast furnace to be in production by September. So the second half of the year, you will start seeing the additional volumes come in from Kalinganagar. We have a blast furnace relining in Jamshedpur starting January. So that will take out some of the overall volumes. But net, we expect the volumes in India to be about 1.4 million tons more this year than the last year.
Okay, that's a fair bit of color then. What about some inorganic growth? Post the elections, the NMDC steel plant could come up for divestment. And there's talks about RINL as well. What's your view on either of these two assets?
No, I think we've said it in the past, our focus will be on organic growth, and we have enough headroom in the existing sites to build 40-45 million tons of capacity. So, so we have enough to do in the existing sites. As of now, we are not looking at new sites, but obviously, if there's something very attractive, we'll think about it. But I think just now we're focused on existing sites.
Well, Mr. Anil Agarwal says that in the coming 2 quarters, he's going to sell his asset. Any talks with them?
Not really, because honestly, for long products, I think for us, the best place to grow is Neelachal, where we've bought an asset which has enough land. We are at 1 million. We are running full out in Neelachal as we speak, and we want to take it to 5 million and then to 10 million. So we have enough headroom there to add long products capacities where we want. We also have the Usha Martin plant that we acquired running full out, and we'll be adding a rolling mill there. So that will add another 300,000-400,000 tons of additional volume. So I think we are quite comfortable in long products as compared to where we were when we originally bid for what was then Electro Steel.
All right, that's the word coming in from Tata Steel. The stock though lower by 4% in trade today.